Right. So tax deducted at source. What is this? First of all, before getting into this chapter, first let us discuss on what is the meaning of tax deducted at source and what is the need of this chapter. That we'll understand. Then we'll discuss on the various provisions which are having in this chapter. So now, tax deducted at source. What is the meaning of source? Source is something I can call that as origination. So tax has to be deducted at the origination. Means what? Say you are an employee in an organization. You are an employee in an organization. When you are an employee in an organization, you will be getting salary. So what is the source? Payment of salary is the source. So payment of salary. Employer at the time of payment of salary, what the employer has to do? Deduct. Say you are getting 60,000 rupees as salary per month. Of that, at the time of payment, employer will deduct a TDS. So what is the TDS amounting to? Say for example, 5,000 is the TDS. He will deduct this 5,000 and he will pay 55,000 to you. So ultimately there are two parties. One is someone called as payer and other one someone called as payee. In this present case, employer is the payer, employee is the payee. I can also call payee as the recipient. Recipient, as the payee is receiving, we'll call him as a recipient. So now, who will deduct? Employer will deduct. Employer will deduct the TDS. Once he deduct the TDS, what the employer should do? Employer should pay this to the government. So whatever TDS of 5,000 which the employer is deducting, this amount of TDS the employer has to pay. So that's what is the background this. So ultimately, how much amount the employer is receiving? 55,000 the employer receiving. When we compute your total income, I should not consider your income as 55. I have to consider your income as what? 60,000 only. Compute the tax, then I have from the tax payable, I will reduce the TDS. Why? Already this TDS is paid by the employer to the government. So I will compute taxable tax on the overall income 60,000 into 12, 7,20,000. On that I will compute the tax. From that tax, I will reduce every month employer is deducting 5,000. So 5,000 into 12. So from this I will reduce the TDS. The balance is something called as a net tax liability. So that is the base of determination of this. So that's what is the background behind your tax deducted at source.
Okay, sir. Can you tell
TDS is being deducted. Say suppose if employer does not deduct this 5,000 as tax, if this employer does not deduct this and he pays 60,000 directly to the employee, what will happen if the employee will not pay the tax to the government? There is a revenue leakage to the government. So that's the reason the responsibility is given to the payer that at the time of payment, you are supposed to deduct the tax. So thereby, even if the payee is not filing the return, even if the payee is not paying any tax, on behalf of the payee, the payer has already paid the tax to the government. So revenue leakage is not there. So that's what is the basic ideology behind your tax deducted at source. Payer at the time of making payment. Okay, payer at the time of making payment should deduct tax and pay tax to the government. That's what is the concept behind this. At the time of making payment, the responsibility is assigned to the payer. He has to deduct the tax and the tax has to be paid to the government.
sir,
Otherwise,
payer at the, sir,
otherwise,
1 minute, sir, I'm writing, sir.
yeah,
Payer at the time of making payment should.
deduct tax and pay the tax deducted to the government. Otherwise, payer will be called as SSC in default. So otherwise he will be called as an SSC in default. It is your responsibility to deduct the TDS, which you have not done. So this will make you to call as SSC in default. You had made a default, so you'll be called as an SSC. Section 190 of the Income Tax Act. Section 190. So now what is this section and what this section 190 speaks about? Let us try to understand. So this 190 says that deduction of tax at source and advance tax payment. So here this is discussing about something called as deduction of tax and something called as your advance tax payment. Okay, so what is this two? Let us try to understand. Now, basically, in the basics of income tax, we had covered that whatever income you earn in the previous year, you are supposed to pay tax in the assessment year. But this is an exception. TDS will be deducted in the same year. Advance tax will be paid in the same year. So now let us see. This section says that total income, the total income, whatever total income you have, the total income of an SSC, total income of an SSC for the previous year, SSC for the previous year is taxable when? In the relevant assessment year, in the relevant assessment year. That's what is the basic principle. And we had also seen the exceptions for this. There are the few cases where total income of the SSC instead of taxable in the relevant assessment year, taxed on the previous year only. So few exceptions were there. But here, however, so what 190 says, it says, however, the income tax is recovered. Income tax is recovered. Okay, from the SSC. Income tax is recovered from SSC. So you are recovering the income tax from the SSC in the previous year only. So income tax is recovered from the SSC when? In the previous year only. In the previous year only. Through what? Previous year only through something called as tax deducted at source and something called as advance tax payment. This another chapter, this will discuss later stage. Okay, so generally the common phenomenon is what? Whatever income you earn, you have to pay tax in the next assessment year. But section 190 says TDS and advance tax, income tax is recovered from the SSC in the previous year only, but not in the assessment year. That's what is the meaning of section 190. Say, suppose, as I mentioned, every month you are getting a salary. Salary, let us consider 60,000 rupees per month is the salary. So 60,000 rupees per month into 12, that gives you 7,20,000 is the
20,000.
salary per annum. So now what the employer is doing, the employer every month is deducting a TDS of 5,000. Let us consider 3,000 rupees is the tax which the employer is deducting every month. So ultimately 3,000 into 12, 36,000 rupees is the tax deducted by the employer. Now, what you need to do? You need to pay tax on this 7,20,000. When? For this previous year 1920, you have to pay the tax on this 7,20,000 the assessment year 2021. Now, in 2021, you need to compute tax on this 7,20,000. So how do I compute? 0 to 2.5 nil, 2.5 to 5 lakhs.
2.5
Yeah, on this 2,50,000, 5%, that is going to be 12,000.
20.
And on this 2,20,000, 10%, that is going to be how much?
22, I guess,
22,000.
sir. 22.
Yeah, 22,000. So 22,000. So what is the total tax liability here? The total tax
30,
liability is coming to
34.
34,000. On this, I need to add a cess component, health and education cess component of
3%.
4%.
Oh, sorry,
4%.
4%.
4%, which comes to what?
1 minute, sir. 35,360, sir.
35 total. Okay, 35,360 is the total. So 35,360 is the total inclusive of your cess component. Okay, let me change this
That is
example here. Let me change this
that 1360, sir. Cess is 1360.
1360. Okay, so the cess is going to be 1360. Let me change this example slightly. Let us consider TDS directed by the employer is 2,500. So if it is 2,500 into 12, what is the total amount of deduction there? 2,000.
30,000.
How much? 27,000. Huh?
30.
30,000. So that is going to be 30,000. Now you are supposed to pay a tax of 35,360, but employer has already recovered this 30,000. Now what is your liability? 5,360 is your liability. When you will pay this you will pay in 2021. In the assessment year, you will pay 5,360, but employer has recovered this 30,000 when? In the previous year, 1991. However, the income tax is recovered from the SSC in the previous year only. How I am recovering? I am recovering this 30,000 in the previous year, either in the form of TDS or in the form of advance tax. This
Okay,
total
sir.
35,000 you will pay in the next year. But in the 35,360, employer has recovered 30,000. So this 5,360 will be paid in the assessment year, and this 30,000 is recovered in the same relevant previous year. That's it. Section number 191. What is this? This 191 speaks about something called as direct payment. This speaks about something called as direct payment. So this speaks about something called as a direct payment. Now, what is direct payment and what section 191 says? So here this says that SSC can pay tax directly. See, section 190 says payer has to deduct the tax. 191 says what? 191 says that tax is payable by the SSC directly in the following cases, not in all the cases. So this section says in in the following cases, income tax shall be paid, income tax shall be paid directly. By whom? Directly by SSC. So whatever SSC is there, that SSC can be directly paying the amount of tax. What are those cases? Let us see. There are basically two cases. First case says that as per the provisions of income tax, no TDS is required to be deducted. No TDS is required to be deducted. So the provisions of income tax says on this payment, TDS is not required to be deducted. Then ultimately, the responsibility will be on whom? On the recipient. Now, as there is no TDS provision for this, the responsibility is on the recipient to pay the amount of taxes. That's it. Now, the next
Sir, I'll
case.
make a note, sir. 1 minute, I'll
Yeah,
make a note, sir.
sure.
So,
Okay. The second point of section 191 says that income in respect of which, income in respect of which, income in respect of which tax is liable to deducted, in respect of which tax is liable, tax is liable to be deducted. Tax is liable to be deducted, but not actually deducted. Tax is liable to be deducted, but not deducted. So these are the following two cases. Means what? Payer should deduct the TDS. Payer has not deducted the TDS. Now ultimately the responsibility of payment of tax is on whom? On the recipient. First case, Income Tax Act Income Tax Act says that TDS is not required to be deducted. Second case, Income Tax Act says you are supposed to deduct the TDS, but the payer has not deducted the TDS. Then ultimately, whose responsibility is that? SSC. The SSC should pay the amount of tax. That's what is section 191. So, okay. Say, suppose there is one provision which we'll discuss going forward. In TDS itself, 194I. Okay, let me take this example. Okay, no worries at present. I will explain this when we go in an order. So this is basically speaks about rent. So what this section says, tenant is there. Tenant paying some sort of rent to the landlord. To the landlord. So what this section 194I says, whenever any tenant is paying any sort of rent to the landlord, it is a subject matter of the TDS under section 194I. So what this section says, if the rent paid per annum exceeds 2,40,000, if the total amount paid by you exceeds 2,40,000, then TDS is compulsory. TDS is compulsory. If the rent paid by you does not exceed 2,40,000, TDS is not compulsory. Say suppose, let me put it like this. Say the rent which you are paying to the landlord is 15,000 rupees per month. So what is the total rent which you are paying? 1,80,000. So in this case, you are paying a rent of 1,80,000. So ultimately, 1,80,000 is less than 2,40,000. So ultimately, tenant is the payer. Tenant is the payer. Owner is the recipient. So ultimately, tenant need not deduct the TDS in this particular circumstances. Now, so no TDS is required to be deducted. So the tenant has not deducted the TDS. Now let us assume this landlord is having two tenants, tenant number 1 and tenant number 2. Two tenants he is having. Second tenant is also paying him 10,000 rupees per month as a rent. 10,000 into 12, the total amounting to 1,20,000. So even this 1,20,000 is less than 2,40,000. So tenant number 1, no need for TDS. Tenant number 2, no need for TDS. So these two people has not deducted the TDS, and the total amount received by the landlord is what? 1,80,000 plus 1,20,000. Total he has received 3 lakhs. This 3 lakhs exceeds that basic exemption limit. 0.0 to 2,50,000 nil. From 2,50,000, this landlord had to pay the tax. But as per the Income Tax Act, TDS is not required to be deducted. So these two people has not deducted. Now, it is responsibility on the landlord to make payment of income tax on the 3 lakhs. So there arises the direct payment in the hands of the landlord. Section 192. It's very simple section. Salary. Any employer at the time of making payment of salary under section 192, he need to deduct a TDS. So this is what is the first payment. So there are a lot of payments which are covered. So now what we are doing? Payment of salary. Payment of salary is subject to TDS. Now let us try to understand this provision here. Responsibility of TDS. Who is responsible? Any person responsible for paying income is responsible. So here the responsibility is fixed on person paying salary. The person paying salary is responsible for deducting the TDS. Now, okay, here who is the payee? Payee means the recipient. The recipient is nothing but the employee. So the recipient is nothing but the employee is receiving the salary. And who is the payer? The payer is nothing but the employer. Employer is nothing but the payer. Employer is the payer, employee is the receiver. Now, every section will be having a rate of tax. Like that, section 192, let us see what is the rate of TDS. Rate of TDS. It says average rate of income tax. So section 192 says income tax has to be deducted at something called as average rate of income tax. What is the meaning of this? Let us try to understand with an example. Average rate of income tax. Say suppose employer will know what is the salary which is going to pay to the employee in a year, because increment, everything will be decided by the employer. So what the employer will do, he will take the total income, total salary income of the employee. Say suppose total salary income of the employee for the year is going to be 7,20,000. So what the employer will do, he will take the total income 7,20,000. On this he will compute the tax. Okay, he will compute the tax. Let us calculate the tax on this, or let us make the calculation simple. Total income is 5 lakhs. Now what the employer will do, employer will compute tax on this 5 lakhs. So what is the tax which is getting there? 12,500 is nothing but the tax. To this we need to add a component of cess. Total tax is going to be 13,000. So what the employer will do, 13,000 in a year. So he will divide this 13,000 with 12, so that every month he can recover that amount as a tax. This is something called as our average rate of tax. So 13,000 divided by 12. The next question is when we are supposed to deduct. So that's what is other important aspect we need to consider. Let us see that. When the TDS has to be deducted at the time of making payment. Let us see. So here the TDS shall be deducted when. Okay, one second.
Yes.
Deducted. Time of deduction of TDS. When? That's what is one of the most important. The provision clearly says you need to deduct the TDS at time of payment of salary. When you make payment of salary, at that point of time, you are supposed to deduct the TDS. Now, okay. So there is one more other thing which we are supposed to see here. Tax on employer will also deduct some sort of tax on non-monetary perquisites. So there is something called as non-monetary perquisites. What is the meaning of non-monetary perquisites? Any perquisites which are not in the form of money, any perquisites which are in the form of facilities are said to be called as what non-monetary perquisites. Say for example, employer is giving you a car. Car is not money, car is a facility. So I will call car facility as a non-monetary perquisite. So employer is giving you some sort of non-monetary perquisites. So whenever any non-monetary perquisite is given by the employer, then the section says that 192 subsection 1A I had to apply. So then we are supposed to apply section 192 subsection 1A. So what this says, under this section, employer may, not compulsory, employer may at his option pay income tax. Employer at his option may pay income tax on the perquisite provided. Employer may pay the tax on the perquisite provided by the employer to the employee. That's what is section 192 subsection 1 is. Say along with the salary, employee may be having some sort of other income. Employee is having a house. He is having some income from house property. So ultimately what this employee should do, employee should provide information regarding other income also. If this employee provides this information regarding the other income, what the employer will do? The employer will also deduct tax on this other income. If he is not providing this information, on this, the employee has to pay the tax on based on your direct payment. We need to go to section 191 there. If employer is deducting, well and good. If employer is not deducting, so ultimately direct payment. So under direct payment, employer has to pay tax on this. If you provide this information, employer will deduct. If you don't provide this information, employer will not deduct. So as employer is not deducting, as it is not liable for TDS, that becomes a part of your section 191. As per 191, you are supposed to deduct. And employer paying salary to the employee. At the time of making payment of salary, employer has to deduct the TDS. At what rate? Average rate of income tax. How that average rate of income tax will be computed? He will compute the total income of that year. On that, he will compute the tax liability. That he will divide with 12. He will be arriving at one amount. That amount will be deducted. When? At the time of payment of the salary. Employer may also pay some sort of non-monetary perquisites. So on the non-monetary perquisite, at the option of the employer can deduct the tax. If the employee is also providing some sort of other income, employer will also deduct tax on the other income also. If employee does not provide this other income, that will become a subject matter of section 191. As a part of direct payment, employee has to pay. Section 192A. Section number 192A. What is this? Withdrawal from employee provident fund. Okay, this section is telling that any sort of withdrawal from employee provident fund. If you withdraw the amount from the employee provident fund, then ultimately section 190 is applicable. 192A is going to be applicable. You are working in a company, every month employer is deducting some money and contributing to the EPF. You had resigned from the company, then whatever money in the provident fund you had withdrawn. Then ultimately section 192A says, as it is taxable, the payer has to deduct the TDS. Here, who is the payer for any sort of section? There will be payer and there will be payee. In this case, who is the payer? Provident Fund Department is the payer. Provident Fund Department is making payment to the payee. The payee is none other than the employee. The payee is none other than the employee. So what this section says? This section says that whenever any payment is made by the Provident Fund Department to the employee, then TDS has to be deducted at 10%. TDS has to be deducted at 10%. Whatever amount withdrawn, on that amount, PF department should deduct a payment of 10%. The remaining balance should be paid to the employee. So suppose your balance in the Provident Fund account is 2 lakhs. On this 2 lakhs, what the Provident Fund will do, what the department will do, 10% TDS, that means 20,000 rupees, they will deduct the TDS and they will pay you 1,80,000. That's what the provision says. And it also says no TDS is required. No TDS is required. When? If payment does not exceed, rupees 50,000. If the Provident Fund Department is making a payment which is not exceeding 50,000, then there is no requirement of TDS. TDS is not required to be deducted. So if it exceeding 10,000, 50,000, 10% is the rate of TDS. And one more important point we need to understand. If PAN number of employee is not available, PAN number of employee is not available, then rate of TDS is not 10%. which is taxable at something called as our maximum marginal rate. We'll discuss. Going forward, we'll discuss what is the meaning of maximum marginal rate. PAN number is available 10%. If PAN number is not available, maximum marginal rate, it is going to be taxable. But practically, this won't happen. Practically, every employee has to furnish the PAN number. So it will be generally deducted 10%. If PAN number is not available, maximum marginal rate. What is maximum marginal rate? We'll discuss at a later stage. That's what is section 192A. Again, let me quickly summarize this 192A. Provident fund is employee has resigned and employee has made an application for withdrawal of the provident fund money. So then ultimately PF department is paying the money to the employee. So at the time of payment, if the payment exceeds 50,000, the provident fund department has to deduct a TDS of 10%. If the payment does not exceed 50,000, no TDS is required to be done. If the PAN number of the employee is not there, it's not 10%, it is a very higher rate, which is something called as our maximum marginal rate. That's what is section 192A. Section number 193. What is this? First, let us discuss what is this section. This is nothing but interest on securities. Interest on securities. Very simple section. For every section, there will be payer and there will be payee. Now, for section 193 also, there is a payer and there is a payee. Who is the payee here? The section clearly says the payee is nothing but a resident. The payee is nothing but a resident. Who will pay generally interest on securities? Generally, the payer here is nothing but a company. Okay. So any person who is said to be called as a company. So here, to be frankly speaking here, any person who is responsible to pay interest, any person who is responsible to pay interest on what? Interest on security. Those person who are issuing securities such as shares, debentures, bonds, whatever it is, on that whatever interest paid, so ultimately that is covered as a part of section 193. So what they are paying? They are paying something called as interest. Interest on what? Interest on security. So then the payer at the time of payment should deduct TDS under section 193. So what is the rate of TDS? The act says the rate of TDS is nothing but 10% is the rate. Again, payer making payment of what? Interest on security. To whom he is making payment? To a resident. Then ultimately he need to deduct a tax of what? 10% on the amount of payment. Say suppose he is paying 1 lakh as the interest. On this 1 lakh, 10% is the TDS. 10,000 is the TDS. 90,000 is the amount which he has to pay to the resident. 10,000 is the amount which he has to pay to the government in the form of TDS. Now, let us see when you have to deduct. Let us see here. The section says you need to deduct at time of credit to account of payee. So when the amount is credited to the account of the payee or at the time of payment, whichever stands earlier, the time of credit to the account of the payee or payment, whichever is earlier. To the credit of the payee means what? Recognition, book entry. You are passing a book entry on accrual basis. So accrual basis or payment, whichever is earlier, within that period, you are supposed to deduct the TDS. That's what is the overall summary behind section 193. Okay. Now, TDS shall not be deducted in the following cases. TDS is not required to be deducted. Required to be deducted under the following cases. What are the cases? Let us see. The first case says that the amount of interest does not exceed 10,000. Okay. You are having something called as 8% 8% taxable tax saving bonds. There is something called as 8% tax savings bond. On this bond, you are getting some sort of interest. If the interest not exceeding rupees 10,000 per annum, then TDS is not required to be deducted on these bonds. That's what the first point says. Then second point, what does the second point says? The same thing almost, but here it is 7.75% government of India bonds. Okay, 7.5% government of India taxable bonds. There is something called as taxable bonds which is issued by the government of India. On this also, if the interest does not exceed 10,000, no need to deduct any sort of TDS. If that exceeds 10,000 per annum, of course, TDS is required to be deducted. Then the next point says, the next thing says that,
Sir, again, your voice went closer. Hello.
hello, the third point says that interest is being paid, interest paid to what? Resident individual. Interest paid to someone called as resident individual. Okay, so interest is being paid to resident individual on what? On something called as listed or unlisted debentures. So interest is being paid to resident individual on listed debentures or something called as unlisted debentures of what? Of a company which is called as widely held company. Once again, widely held company. I will explain what is the meaning of widely held. So which is nothing but something called as a widely held company. Okay, widely held company. And how the interest is being paid? The interest is being paid by something called as account payee check. So the interest is being paid by account payee check and does not exceed rupees 5,000 during the financial year. So there is a widely held company. What is the meaning of widely held company? Public limited company, the company in which wide number of people are interested. So which is nothing but a public limited company. A public company is there. The public company is giving some sort of interest. So whatever interest which is paying, it has to pay by account pay check. And if the interest does not exceed 5,000, the widely held company need not deduct any sort of TDS if this does not exceed 5,000 rupees per annum. So it's not only public limited company, listed or unlisted, even a company which is not listed can also take this advantage. So if the total amount of interest does not exceed 5,000 and you are paying that in the form of account pay check, then TDS requirement is not there at all. Then the next point, it try to say that securities of LIC, Life Insurance Corporation, is having a securities. So ultimately, Life Insurance Corporation is paying some sort of interest to its subsidiaries. Interest is paid by the Life Insurance Corporation to its subsidiaries. Then ultimately, no TDS is required to be deducted. Then, okay. Then the next point says that interest payable, what? Interest payable on securities, interest payable on securities issued by a company. Okay, interest is payable by a on a securities issued by a company where such securities are held in demat form. If the securities are held in physical form, if the amount of interest exceed 5,000, then TDS is to be deducted. But if the same securities are held in electronic form, which is nothing but your demat, then TDS is not required to be deducted even if the interest amount exceeds rupees 5,000. That's what is the other provision which is speaking about. So again, roughly if we try to see, it's very simple. 193, payer making payment of interest on security to a person called as resident. 10% is the rate of interest which he need to deduct. But in some cases, he need not deduct the interest where it is a tax savings bonds, 8% tax savings bonds, and the interest amount does not exceed 10,000, or it is 7.75% government taxable bonds. Even on that, if the interest does not exceed 10,000, no need to deduct any sort of TDS. Any sort of company paying any sort of interest, if the interest is paid through account pay check and the amount does not exceed rupees 5,000 during the financial year. But if the same interest is on security held as a electronic form or in demat form, irrespective of the amount, no need to deduct any sort of TDS. LIC is making payment of interest to its subsidiaries, no need to deduct any sort of TDS. Apart from these cases, wherever any person at the time of credit to the account of the payee or at the time of payment, whichever is earlier, TDS has to be deducted at 10%. So 10% has to be deducted. Say suppose 1 lakh is the interest on security, 10,000 is the TDS, 90,000 should be paid to the payee and 10,000 should be paid to the government as a form of your TDS. That's what is section 193. Now let us quickly cover something called as 194A, which is also very simple. 194A. Section 194A. So what is this? Section 194A is nothing but interest on interest other than interest on securities. Why? Because interest on securities already section 193 is covering. So apart from interest on securities, whatever other interest you have, that other interest will be covering part of your section 194. Means what? Loans. There is something called as loans. On these loans, you need to pay some sort of interest. So that interest on loan, any interest other than interest on security, forms part of section 194. Best example is loan. You have taken a loan from a person. To that person, you need to make payment of interest. So you are the payer and the person is the payee. And you are paying interest. And this interest is what? Not an interest on security. Then ultimately we'll be applying section 194A. Now, let us see. This applies for whom? This applies for all SSC. This applies for all SSC. Other than. This applies for all SSC other than whom? Other than individual and HUF. This applies to all person other than individual and HUF. But even this is applicable to individual HUF if they are covered under something called as tax audit. So it is applicable to all SSC other than individual and HUF who are not covered under section 44AB. If this individual and HUF are not covered under tax audit, then this section is not applicable to them. If this individual HUF are covered under tax audit, 194A is applicable to individual HUF. Generally, 194A does not apply to individual, does not apply to HUF. If the individual is covered under tax audit, then ultimately what will happen? 194A is applicable even to the individual as well as the HUF. That's what is one most important thing we need to understand. This point is applicable for payer, the person who is making a payment. The person who is making a payment should be other than individual HUF to all the people this provision is applicable. Let me give an example. Say, as I said, you have taken a loan from Mr. Y. You have taken a loan from Mr. Y. So ultimately, here, what you are doing, you are, say, let us consider Mr. X has taken a loan from Mr. Y. So ultimately, what X will do? X will pay interest. So X will be called as payer. Now, Mr. X is an individual. Mr. X is an individual. Now, what this provision says, this provision will not be applicable to Mr. X. Mr. X being an individual, he need not take the TDS. But if the same individual is covered under tax audit, Then ultimately, this person need to deduct the TDS when he is making a payment to Mr. Y. That's it. Now, so here, payer should be this, and who should be the payee? Let us see. The payee should be always for this section also resident person. If he is a non-resident, we are not going to apply section 194A. So again, to repeat this section, the payer should be, can be any SSC, but not individual and HUF. This section is also applicable to individual HUF if the same person is covered under something called as tax audit. And the payer for section 193, section 194A should be always a resident for this purpose. Then in that case, the rate of TDS is same as 193, means what? 10%. Whatever interest you pay on that interest, 10% is the rate of TDS which you are supposed to deduct. Now, time of deduction. What is the time of deduction? If you are not deducting in time, you need to pay interest on that as well. Now, what is the time of deduction? Same as 193A. That means what? At the time of credit to the account of payee or payment, whichever stands earlier, by that point of time, you are supposed to deduct the TDS. That's what is the thing which is mentioned as a part of your section 193. Now, exceptions. When TDS is not required to be deducted as a part of your section 194, that we'll try to discuss. Okay. So now, no need for deduction of TDS.
Sir,
Yeah. No TDS is required to be deducted under the following cases. Case number 1. Here, payer is a banking company. Payer is a bank. So I cannot call the word as a company because this provision is applicable even if it is a scheduled bank, even it is a cooperative bank or whatever it is. Any person who is a payer engaged in something called as a banking business, okay, is making payment of interest. Bank is making payment of interest in respect of deposit, whatever deposit which you are doing. So on that, the bank is making payment of interest. If the amount of interest per annum does not exceed rupees 40,000, you just try to understand this properly because the recent amendment. Okay, so this is the recent amendment with effect from 1st April 2019. Before this amendment, the limit was 50,000, not 40,000. Before this amendment, the limit was 50,000. Now the act was amended to 50,000. So here, bank is making payment of interest, and if the interest does not exceed 40,000 per annum, then there is no need to deduct any sort of TDS. Now, if the same interest is paid to a senior citizen, then it is rupees 50,000. If the interest is not paid to a senior citizen, maximum limit is 40,000 per annum. If the interest is paid to senior citizen, the interest is going to be 5,000. This applies not only for bank, this also applies for the post office. Whenever the post office is also paying some sort of interest, the same provision applies to post office and the same provision applies to bank. So, in case of any other payer, if the payer is bank or if the payer is post office, 40,000 or 50,000. In any other case, in case of any other scenario, if the interest does not exceed rupees 5,000 per annum, no requirement of TDS is to be deducted. So that's what is one important thing we need to understand. Apart from this, interest paid to partner. A partnership firm is making payment of interest to the partner. So even on this, there is no need to deduct any sort of TDS. Then you are making payment of interest paid to government, whether it is central government, whether it is state government or local authority, if you make any sort of interest payment to the government, or you are making interest payment to bank, I have taken a loan from a bank, I am making repayment to the bank, even in that case TDS is not required. But when the bank is making payment to you, TDS is required to be deducted if the amount exceeds 40. But when we make a payment to government or bank or income tax department, so whenever you are making any sort of payment to even income tax department interest payment, then also there is no need to deduct any sort of TDS. Whenever any sort of interest is payable to LIC or any statutory companies, even then the requirement of TDS will not be there. So these are the cases where, and finally the last one, income paid or payable, income paid or payable, income paid or payable by whom? By an infrastructure company. Okay, infrastructure company or infrastructure capital fund or a public sector company in relation to something called a zero coupon bond. Even on this there is no requirement to deduct any sort of TDS. That's what is section 194A. One second. Yeah, first example, point number 1. On 1st June 2019, on 1st June 2019, Mr. Harish made a 6-month fixed deposit. Harish made a 6 months fixed deposit FD of rupees 10 lakhs, What is the rate? At rate of 9% per annum. With a bank, whether it is a cooperative bank or scheduled bank, we are not bothered. Fixed deposit matures on 31st March 20. That's what is the given case. Now, here I need to say what is the amount of interest which bank is paying for this period. That's what I need to calculate. So the interest is paid from which period? June. That means apart from April, May, the interest is paid by the bank for the entire 10 months. Now, what is the amount of interest? Let us calculate the amount of interest here. So the principal deposited by Mr. Harish is 10 lakhs. On this, 9% per annum. Finally, I need to charge this for 10 months. So into 10 by 12, that will give you the amount of interest. If the amount of interest does not exceed 40,000 per annum, assuming Harish is not a senior citizen. So if it does not exceed 40, the bank need not deduct any sort of TDS. But here, the amount is 75,000, exceeded 40,000. So hence, the TDS required to be deducted is nothing but 75,000 into 10%, 7,500 rupees is the TDS which you are supposed to deduct. That's what is the first. Read the question again. On 1st June 2019, Mr. Mahesh made 3 9-month fixed deposit at rate of 9% per annum. Deposit matures in the financial year 1920, which is on 28th February 2020. Amount deposit is nothing but 3 lakhs. Now, 3 lakhs is the amount deposited. What is the rate of interest there? 9%. 3 months. So what I will do? First of all, I will consider it as 9%. 3 9 months. That means what? 3 into 9 by 12. That's it. 3 9 months means 3 into 9 by 12. If I'll do, I'll be getting the value. So if I do this, I'll be getting the amount of interest. If the amount of interest is less than 40,000, nothing is to be deducted. But if the amount is more than 40,000, assuming Mahesh is not a senior citizen, TDS is supposed to be deducted. What is the value there? Right. So now comes section 194B. and 194BB. What is section 194B and what is 194BB? Let us try to see. 194B and 194BB. B is nothing but whenever, let us see, you are having any sort of income, especially from lottery, winnings from lotteries, winnings from crossword puzzle, winnings from any sort of puzzles, any sort of card games, any sort of what to say, any games, whatever game you play, from that games, if you get any sort of money, then ultimately 194B is applicable. Say suppose kaun banega karodpati, or you are playing some games in MPL. Okay, so whatever games you play, if you are getting any sort of money, then ultimately 194B is going to be applicable. Then 194BB, any sort of income you are getting from race horses, you are playing horse race. So whenever you are playing horse race, whatever income you get, ultimately that will be covered under 194BB. It's not horse race, it's some other animal. Say, basically in Shankranti in Andhra Pradesh, will be having hen fighting. So if you are having hen fighting, I cannot call that as a horse race. Ultimately, that will be coming under game of any sort. It will not be coming as a purview of 194BB, but it will be coming as a part of 194B, and section 194B is applicable, but not 194BB. Now, what is the rate of TDS? Okay, so here applicability is nothing but this. So again, for any section, you will be having a payer and you will be having a payee. If you remember, for section 193 and section 194A, we were calling the payee as only resident. But for section 194B and BB, both the cases, the act clearly says the payee can be resident or the payee can be non-resident. The payee can be resident or the payee can be non-resident. And what is the TDS? The rate of TDS is nothing but 30%. You are winning 1 lakh in Kaun Banega Karodpati. So ultimately what will happen on the 1 lakh? 30% will be deducted as a TDS. You will be getting 70,000 and 30,000 will be paid to the government in the form of TDS. Now, no TDS is required to be deducted. If the amount does not exceed, rupees 10,000, then no TDS is required. Same case here, does not exceed 10,000, no TDS is required to be deducted. Section 194C. Section 194C. So this section 194C is speaking about any sort of payment. Whenever you are doing any sort of payment, to whom? To person called as contractor or person called as subcontractor. You are engaging a contractor, catering. Say there is some festival or there is some function which is happening. So generally what I will do, I will give the contract to the food caterer. So ultimately the food caterer is a contractor. Now what I am doing, I am making payment to the food caterer. So now ultimately the application of section 194C will be there. Whenever any payment is made to a person who is called as a contractor or he is called as subcontractor, then 194C is going to be applicable. As every section, 194C is also having something called as payer, and 194C is also having someone called as payee. Now, let us see who is payee and who is payer. Payee for this purpose means resident SSC. Resident SSC. What is the meaning of resident SSC? He is resident in India. He can be individual, he can be HUF, he can be firm, he can be company, he can be anything, but his residential status should be Indian. He should be called as a resident. Then ultimately he is called as a payer. Payee. That means who is payee here? The payee is none other than your contractor, or the payee is none other than your subcontractor. The subcontractor or the payee should be resident SSC. Then who is paying? Let us see. The payer can be any SSC other than individual and HUF. Same as 194A, other than individual HUF. But if this individual and HUF, are covered under tax audit, so other than individual HUF, not covered under tax audit. If the individual HUF are covered in a tax audit, then if he makes a payment, then 194C is also going to be applicable. So that's what is nothing but your section 194C. Again, any person who is other than individual and HUF, not covered in tax audit, making payment to a contractor or making payment to a subcontractor, and that contractor or subcontractor is someone called as a resident SSC, then ultimately TDS is supposed to be deducted. Now let us see what is the rate of TDS which you are supposed to deduct there. That's what we'll try to understand now. Now, rate of TDS. What is the rate of TDS? I need to see whether the payee is individual or HUF, or whether the payee is other SSC. Here we had called him as resident SSC, means anything, he can be individual HUF or other SSC. So if he is an individual or HUF, the rate of TDS is 1%. The rate of TDS is only 1%. In the case of other SSC, the rate of TDS is going to be 2% is nothing but the rate of TDS. That's what is one important point we need to remember in the case of your 194C. So no TDS is required under the following cases. No TDS required to be deducted under the following cases. What are those cases? Let us try to see. Now, payment does not exceed rupees 30,000. If the consideration paid to the contractor does not exceed 30,000 in a single payment, if the amount does not exceed 30,000, then TDS is not required to be deducted if that is a single payment. Some cases, what will happen? Say, I am having a canteen in my company. So that canteen, I had given a contract for catering. So what will be happening? The payment will not be a single. The payment will be periodical. Every month, I need to make a payment to him. So in that case, it is not 30,000. In that case, what it says, if the payment does not exceed 1 lakh in aggregate, because every month I am paying some money to the contractor. So 1 lakh in aggregate during financial year. So during the entire financial year, whatever money which I pay to the caterer, if the total does not exceed 1 lakh, then ultimately I need not deduct the TDS. It's not a periodical. Say some annual day is happening in your company. So when an annual day is happening in your company, you are engaging a caterer for that annual day event. So then ultimately what it will be a single payment. So if the single payment does not exceed 30,000, no need to deduct TDS. If it is a periodical payment, the aggregate, the total of all the payment made to a same person, if it does not exceed 1 lakh, then ultimately no need to deduct any sort of TDS, or else you need to deduct a TDS at either 1% or at 2%. That's what is the first exception in which TDS is not required to be deducted. That's what is the first case. The next case is quite important. Now, what is the next case here? The next case is here, the payer. The payer, okay, 1 second. Yeah. the payer is individual or HUF. See again, if I go back, the section says if the payer is individual HUF, ultimately the section says it is not applicable. But here what it says, if the payer is not covered under tax audit, then only this provision is not applicable. So here, what this provision is trying to say here, payer is individual HUF who is covered under tax audit, who is covered under tax audit. If he is not covered under tax audit, then I need not discuss this an exception at all, because he need not pay the TDS. So he is covered under tax audit. But what he is doing? He is making payment to whom? Making payment to someone called as contractor. Why he is making payment? Because of the personal purpose. He has taken the contractor for the personal use. For the personal purpose, the amount is paid to the contractor for the personal purpose, either for himself or for his family members. So whenever the contract is taken for the personal purpose, even if the individual HUF are covered under tax audit, as the contract is not for his business purpose. So ultimately 194C says no need to deduct any sort of tax. Then the next exception says that you are someone called as a contractor and you are engaged in something called as hiring, leasing of trucks. You are engaged in the business of hiring and leasing of trucks. In that case also, I can pay any amount without deduction of TDS, provided this contractor is having a PAN number. If the PAN number is there, whatever amount which I am paying for taking the trucks on hire or trucks on lease, no need to deduct any sort of TDS if the PAN number is there. If PAN number is not there, non-availability of PAN number will result in something called as TDS at 20%. PAN number is there, no need to deduct any sort of TDS. In case of non-availability of PAN number, you are supposed to deduct the TDS at something called as 20%. That's what is the next exception which we need to consider. So these are the purely exceptions where TDS is not required to be deducted in case of section 194C. One second. Section 194D. What is this basically? This speaks about something called as insurance commission. You are acting as an insurance agent. Okay. So the insurance company is making payment of insurance commission to its agent. So as every section have a payer and as every section have a payee, 194D is also having a payer as well as payee. Who is called as payer here? Insurance company. Insurance company is said to be called as a payer. Now, who is payee? Resident SSC. The payee can be resident SSC. Means he can be a resident individual, he can be a resident HUF, resident firm, resident company, whatever it is, his resident status should be resident in India. Then, if the conditions are satisfied, then what? The payer should deduct TDS at what rate? 10%. So the TDS rate to be deducted is nothing but 10% is the rate of TDS which the payer has to deduct. Now, no TDS is required when? If the payment does not exceed rupees 15,000. If the payment does not exceed rupees 15,000 during the financial year, that means entire financial year, if the total amount of payment does not exceed 15,000, TDS is not required. Otherwise, the insurance company at the time of making payment to the resident SSC should deduct the TDS at something called as 10%. That's it. That's what is 194D. Okay. So now, so basically, yeah,